Good morning, and thank you for joining the BCM Strategy, Inc. Eventbrite webinar on Pandemic Policymaking Round 2. Are you ready for what comes next? Today's webinar will focus on providing analysis and trend projections based on concrete objective data that we create from our patented process. We're going to zoom, forgive the pun, zoom through very quickly a broad range of policy issues, from artificial intelligence policy and trade to energy and renewables, Libor transition, banking regulation, digital currency, and Brexit. You are more than welcome to ask questions. We'll have particularly some time toward the end. The meeting is being recorded, and a copy of the recording will be provided as a courtesy to all participants after the event. With that, let's get started. So first, some introductions and some background. My name is Barbara Matthews. I'm the founder and CEO of BCM Strategy, Inc. We are a technology company using patented technology based on not only my academic background with multiple advanced degrees in international relations and international law, but also concrete experience in the public policy process at the global level in Europe, in Basel, in the United States. The policy trend projection we're going to focus on is, in fact, driven by the patented data. We're presenting a new way of looking at policy risk, which is backed by political science and data science, because we are converting the words of the public policy process into structured data using advanced patented technology. The problem we're solving is information overload, which is real and a problem. It creates the opportunity for people to make very mistaken decisions based on bad information. In order to appreciate why it's important to quantify public policy risks, it's important to debunk a couple of misconceptions about what policy risk is. Many people believe public policy is nothing better than a dartboard, or in the language of the markets, a random walk. They may believe that policymakers are evil. They do not have people's best intentions at heart or in their minds. That some are very cynical and believe policymakers are corrupt or simply clueless. Regardless of where they start, many people conclude that it really is impossible to anticipate public policy risk outcomes, and that you really need a crystal ball to see around the corner. We disagree. In my experience, most policymakers do in fact care about getting it right and making a good decision. They may not always get the right decision, but they care about trying. And the public policy process is all about trying to find a consensus that works for a given community. So with that in mind, we have devised a mechanism that is data-driven, objective, and transparent. And to get things going, we're going to run a little poll. And the poll is a bit of a warm-up. So which of the following did not occur at the height of the pandemic policymaking process between March and April of this year? There are a range of options, and please do vote. Your options are: the Maastricht Treaty was suspended, so the classic fiscal policy rules in the European Union didn't apply. Basel capital rules were overridden. The Schengen Treaty in Europe was suspended. So the Schengen Treaty is all about free motion in Europe. The only thing that happened for 2 months was COVID-related. Regulatory reporting and public disclosure requirements were suspended or delayed, and over 75 export bans were implemented globally. And so the answer is, so which one did not occur? Excellent answer, because this is correct. A range of public policy activity. Good job, guys. A full range of public policy activity in fact did occur. I'm sharing the results now. We have a great audience here on the line, which is fabulous, because you do know that policymakers were not asleep at the switch. And so the question then becomes, what does the arc of public policy look like for COVID-19 when we start to quantify that? So we experience the public policy process as humans in a linear way. That's everyone. That includes policymakers themselves. And this is what public policy looked like in March. Chaotic. The green line is action. Policymakers were really throwing the kitchen sink at an incredibly challenging, simultaneous stop to both supply and demand functions globally as the economies went into lockdown. The same dynamic occurred in April, albeit at a more attenuated level. This would be April and this would be May. But the big picture is a little different. So elevated activity levels remain in place today. This is May. We're not even finished with May just yet. Mobility levels may be increasing for individuals, but the policy process is still close to the high water mark from last month. The only reason I would suggest that public policy is slowed is because policymakers are effectively taking a breather. We don't know whether second wave infection challenges are going to require additional monetary policy tools, additional fiscal policy, or additional technology policies, contact tracing. So while we may experience the policy process in a chaotic manner, the reality is, and every data scientist knows this, every market analyst knows this, when you look at the big picture, it's a smoothing function that provides perspective that is important for strategy formation. On any given day, and this is data from our platform, on any given day you can see where activity is concentrated. These screenshots were taken on the 8th of April. And so this would be at the height of the pandemic policy process. And you can see here, banking was the most active. It's not surprising. This is when policymakers were shoring up the banking system and making sure that it did not collapse. And many have remarked to me, those who read our reports on a regular basis or use the platform, what they found surprising was that Brexit was still active in that period as well. And from here, we're going to head into the individual policy areas, and we'll have time for questions at the end. So first, we'll start with trade policy. And we've got another poll, which we're going to launch right now. Poll number 2. Which of the following actions has the World Trade Organization or the G20 taken to repair shattered supply chains? There's only one answer that is correct. Import tariffs have been cut to 0 for personal protective equipment and medical equipment. They've been cut to 0 for industrial goods, agricultural goods. New phytosanitary and cargo disinfecting standards have been created. And statements have been issued pledging allegiance to the importance of well-functioning supply chains. We'll leave the voting open for a few more seconds. Five, 4, 3, 2, 1. All right. Polling has ended. I'm going to share the results. For those of you who voted for import tariffs having been cut to zero in one or all places, I am sorry to tell you that these were not actions taken at the multilateral level. Individual, national, or in the case of the EU, supranational organizations have taken those steps. But in fact, the multilateral process has really only issued statements. Now, I know the statements can be important. I have drafted a few myself in my day as a policymaker, but I am sorry to say that in this particular case, actions do speak louder than words. So, with that in mind, we will stop sharing the results and get into the sad truth is that trade policy is missing in action. So if we did, and when I did this morning to put these charts into the presentation, the chart for trade war for this year, you can see the action line. There was some concern about trade war, but mostly policymakers weren't even talking about trade war. It was a steady slope downwards. In other words, even when export restrictions were being created, no one was complaining, mostly because policymakers were all taking the same action. We are now in a phase where policymakers increasingly are worried about and talking about trade wars, and fortunately not doing very much. On a day-to-day basis, it can feel chaotic, as noted earlier, and that's what this chart shows. So this chart shows that a policymaker basically takes action that can be interpreted as a trade war item, such as an export ban, and then rhetoric follows from there as policymakers react. So it's a fairly predictable inverse relationship. If instead we look at tariffs and trade, we see slightly more activity with a bump up in April as the policymakers started playing and experimenting with how to incentivize certain types of trade. But on a day-to-day basis, also very spiky, it feels very chaotic. This purple spike is actually litigation at the WTO between the United States and India regarding sugar subsidies. Along the way, there were there were components of the Boeing-Airbus dispute that popped up. None of that was COVID-related. All of it was dispute-related. None of it was about the thing that mattered the most in that period, and that was finding concrete ways together actually to repair the shattered supply chains, whether those are through standards on phytosanitary conditions or zero tariffs. So with what comes next, we're going to run another poll. And this time around, I'm going to stop sharing my screen for the moment so you don't see what's happening as I launch the poll. All right, true or false? The pandemic has accelerated policy making regarding central bank digital currency issuance in all major jurisdictions, including the United States. In other words, while the kitchen sink was being thrown at the pandemic and COVID-19, were policymakers also taking action on central bank digital currencies? Everyone has finished. And the answer is yes, it has. For those of you who voted false, we're about to show you why. Indeed, the policymaking process has actually accelerated. Screen. And here we have the reaction function. Interestingly, for the media that we cover, there's hardly been any coverage of this in the media. So the good news is that our webinar participants are very well informed. The interesting part, so this is the time series from January 2019 to the present. And what you can see here is the policymakers had a nearly parabolic rate of increase with respect to CBDC policy issues heading into the pandemic. And it is true that between March and April, activity ceased, but it didn't cease completely. And that's the important part. It did not cease completely. And then, obviously, we're seeing quite a rebound. The chart on the bottom shows you the small spike, and it becomes a little bit clearer. The rate of activity from February to March was increasing even as the lockdown was occurring. As the lockdown intensified in March, activity slowed, and this is really in April when we could see policymakers starting to adjust to a new reality and realizing what they need. What does this tell us about where policy is going? Among other things, the requirement that fiscal support measures to individuals from governments need better distribution mechanisms has really lit a fire under the policy community. At the height of the policymaking recovery bill legislation process, there were 3 bills pending, which are still pending in Congress, suggesting alternative ways to deliver cash to individuals from the federal government, most but not all of which involved working through the central bank, the Federal Reserve. The Bank of England, the ECB, the Bank of Japan, the Hong Kong Monetary Authority, the Bank of Thailand. I mean, there are a number of central banks actively engaged. This by itself is worth its own webinar. I am sorry we can't stop and linger on the issue. But the point is that every one of the major G7 central banks has announced either pilot programs or concrete ideas for how the architecture of a central bank digital currency could be structured using third-party technology in the middle of the pandemic. If there is interest, we can always have an additional webinar or conversation about that. So, moving on to artificial intelligence, and we will launch the next poll and stop screen share for a second. So, true or false, AI policy formation has ceased due to the pandemic. Five, 4, 3, 2, 1. Polling, share results. All right. 33% of you got it right. Active AI policy formation in the United States has indeed ceased, but not in Europe. And the trick to this, of course, is that direct policy formation with respect to artificial intelligence is rather an elusive target. Effective monitoring requires tracking a range of different intersecting issues. At its core, artificial intelligence policy is really about the data that's being used to train the AI. And so for that, we need to look at data privacy, the regulation of data privacy algorithms, this chart here. And then when policymakers talk about data privacy in the context of the coronavirus. As these charts show, if the focus is data privacy and the coronavirus, the reality is that for everything that you read about contact tracing and Bluetooth handshakes and GDPR in Europe and data privacy in the United States, very few policymakers are actually making decisions based on the coronavirus context. Instead, we have to look at a bank shot for policy trend identification by looking at what policymakers are saying about the big picture, about data privacy itself, and about data privacy in the algorithmic context. This is where the center of gravity is for policymaking. It will surprise very few people on this call that the most active discussions remain in Europe, this being the day after the GDPR celebrated its second anniversary. There is a great deal of work yet to be done in this space, but the point is that AI policy is not actually being driven by the COVID-19 reaction function. The decisions, the substantive decisions, are not being driven by COVID. The policy priorities that remained in place prior to the pandemic, which is what this 2019 to 2020 chart shows, is what's important. Moving on to Libor. We will then launch the Libor poll. So which of the following is not true with respect to the Libor transition? Market volatility in March caused policymakers to stop work on Libor transition issues. Benchmark transition regulation policy has accelerated in the United States. The Bank of England has announced new enforcement standards for noncompliance with Libor transition. And finally, IOSCO and the Basel Committee have asked jurisdictions to reassess the Libor transition timeline due to the pandemic. Five, four, three, two, one. I'm going to end the polling here and share the results. It was a photo finish. The reason why the benchmark transition regulation policy issue is wrong is because it was already accelerated in the United States. So, and people were split on these two issues. In fact, the false answer is that IOSCO and the Basel Committee have not asked for a reassessment of the timeline. There is absolutely no retrenchment in the official sector with respect to the timeline for the Libor transition. And in fact, in the last 2 weeks, the Bank of England has indeed announced new and more stringent standards for noncompliance with the Libor transition. So policymakers are very committed to moving forward here. And this chart shows you how this is true. Activity levels remain elevated, and while the May levels are down, we're not finished with May yet, so this is an incomplete data set. The important thing to note here is that policymaking remained elevated and roughly stable throughout the COVID-19 emergency policymaking cycle. It was hard to see that, though, because, of course, very few media reported on it. There was some media reporting on it, which is what the blue line is. but you had to really be dedicated to find these details. Energy and renewables. We are going to have another poll. And launching now. True or false? The massive economic upheaval associated with the pandemic is creating retrograde economic and financial policies as regulators prioritize jobs over the health of the planet. True or false? Five, 4, 3, 2, 1. Polling share results. And share screen. You are evenly split. And this was a bit of a trick question, because the focus here was on economic and financial policies. And it is really hard to identify a policy trajectory when so many policymakers do indeed talk quite a bit about ensuring that the recovery is a green recovery, or that fiscal stimulus spending reflect climate priorities. The actual answer is false. It hasn't now. I know that that's going to create some stir in some quarters, because a number of people fuss over whether fiscal funding is being allocated to carbon industries. But from our perspective here, when it comes to energy and renewables policy, we're looking specifically at the disclosure agenda. So it was a bit of a trick question, for which I apologize. And on the disclosure agenda, if you think about the renewables and energy policy, you do experience it like this. You experience activity levels decreasing. People who follow this issue closely were very excited about the way the year started, with the BIS in January launching the Green Swan report and identifying climate change as a significant policy focus across the board. So that's for monetary policies, for financial disclosure policies, for scenario analysis and risk management policy. And from that high water mark, especially with respect to renewables and energy, it is true we've seen a steady declining function of activity directly related to renewables and energy. But if you look at the activity related to financial disclosures, which have a very significant impact on market incentives, this actually has been increasing rather dramatically over the pandemic period. It also happens to coincide with what is traditionally the reporting period, when financial institutions and corporations must compile their annual reports. So the timing here is not coincidental. The policymaking community across the board, and that includes in the United States, although not as directly as many would like, the policy community across the board is increasing the pressure on publicly traded companies and public companies in general to increase their disclosures as to how climate change risks impact their bottom line. It will be interesting to see coming into the second half of the year how companies disclose the relationship between climate change and pandemics. I expect we will see a second round of activity in the autumn based on the sufficiency of that disclosure policy. With respect to renewables and energy and related fiscal policy issues, The activity levels here in May may be small, but they are very, very strategically significant. Among other things, the Deputy General Manager of the BIS has been delivering a range of speeches identifying and encouraging the economic establishment to research ways in which negative externalities associated with climate change can be affirmatively priced through Bakuvian taxes or otherwise. Following the language here is crucially important. The policy community is gearing up to continue, if not accelerate, their policy making beyond the disclosure space. This is not a big data universe. Small moves can make a massive difference in the incentive structure in the economy. The economists at the BIS know this, and so following it at a very close level is crucially important to spotting inflection points as they occur long before they hit the headlines. Which takes us to the rather arcane universe of banking and macroprudential policy. And we will then launch the poll for that issue, which is very technical. Those of you on the call who are not banking experts, I apologize in advance for how technical this is. So we have here a range of very technical elements that go into the regulatory capital requirement for banks. Some of them are straight up Pillar 1, Pillar 2, or operational risk. And the question is, which one of these has not been relaxed or suspended due to the pandemic? These are very technical areas, so if you aren't a banking expert on the call, you probably haven't even seen some of these acronyms. So the CCYB is the countercyclical capital buffer. The NSFR is the net stable funding ratio, and specifically, despite the typo, is the definition of high-quality liquid assets. There's the leverage ratio. There's Pillar 2 capital, so Pillar 2 has a little bit more discretion to it. It's not as quantitative. There are non-performing loan provisioning rules, and then there are the operational risk rules. So banks must hold capital to cover the risk of doing business. All right, 5, 4, 3, 2, 1. I'm going to share the results and share my screen, and then we can discuss. All right. Only one person got this right. Every single one of these components has been suspended or relaxed due to the pandemic, except for operational risk. The operational risk rules are the only ones policymakers have not touched. For those of you who are real experts on the call, if you were looking for a statement by the Basel Committee, you will have a hard time finding it. Most of these rules were relaxed by one jurisdiction or another, and then the others followed. So in some instances, so for example, with the high-quality liquid assets definition, I believe it was the United States that exempted central bank reserves first. Or it actually might have been the Bank of England. But either way, they followed shortly thereafter, and the European Central Bank and the European regulators followed after that. The countercyclical buffers were the first to go, but not in a coordinated way, and the same is true for the leverage ratio and Pillar 2. And this is what it looks like. If you plot the policy reaction function for COVID-19 against the policy reaction function for the countercyclical capital buffer, what you see is correlation. The scale is different because, of course, there's only a small amount of activity associated with the CCYB, but the pattern is the same. And the pattern reflects not only a growing sense of concern, but also a reaction function among the policymakers themselves. One policymaker in one jurisdiction took action, and another one would follow from there. They were learning from each other. Importantly, they were not complaining. So one of the things that we see quite a lot in regulatory capital policy is a great concern with level playing fields and a great concern by policymakers that jurisdictions not gain an unfair competitive advantage by providing easier rules for their banks in one jurisdiction over another. This did not occur during the policy cycle in March. And it didn't occur, obviously, because the system was under a great deal of stress. But it also didn't occur because policymakers were following each other's cues. So for those policymakers and those advocates and those analysts that complain about the lack of coordinated action, that there may not have been a big press release saying everyone was going to take the same action simultaneously in the same way. That is true. But they were taking convergent actions. Their policies were convergent with each other, and they were watching what each other were doing. Last but not least, Brexit. And the last of our polls as well. So we're going to stop sharing. Which of the following is not true regarding Brexit policy? The Bank of England has created a de facto transition period that goes past January 2021 by promising to continue to implement EU regulatory standards for a period of time, not indefinitely. Prime Minister Johnson's government has pledged to continue permitting Northern Ireland to enforce EU customs rules and will hire 50,000 additional customs inspectors to do the job. The EU is scheduled to deliver an equivalence determination regarding UK financial services rules next month. Fishing rights are proving to be one of the most difficult and controversial issues in the current Brexit negotiations. Migration issues are no longer a sticking point because all travel is suspended due to the pandemic. Financial regulators on both sides of the English Channel created regulatory standards in February 2019 that would take effect automatically upon Brexit, and none of the above. Five, 4, 3, 2, 1. And polling, share results, and share screen. All right. The majority of you say none of the above, and you are right. Every single one of these things has occurred. Every single one of them. And it shows the importance of actually reading what policymakers say and do rather than just reacting to a headline. One of the things that makes our technology so powerful is that it actually reads the language. It doesn't just read the headline. And so the if you look at the reaction function in May, it is very clear that Brexit is happening now. And while it is true that policymakers talk a lot more than they act on Brexit, you can see here the successive attempts and growing attempts to shift policy as significant decision dates appear on the horizon in June. If if you look at it from a bigger perspective, over the course of the last year and a half, aggregate activity levels have decreased overall because it is clear that Brexit is happening, and it's just a question of how. In February, back here, this is when a number of automatic regulatory rules were put into place by ESMA, the European Securities Markets Association, the EBA, the European Banking Authority, various ECB-related entities, and obviously the regulators in London. When they did not know when Brexit would occur, they basically put into place rules saying whenever it happens, the next day, the following legal framework applies. So a high degree of activity isn't necessary right now. The activity that does occur is very intense, of course. And finding a way to address the individual issues is certainly going to require a fair amount of movement on both sides in order to get to an agreement that is workable. But the point is that, like in the other areas, we don't need a lot of activity. This is not a big data activity. You just need to be able to find what policymakers are doing in those areas which may not be capturing a high degree of media attention. And that's the other thing to note about these charts. So not only is it important to read what policymakers are saying and doing, there's a very significant delta between that and what happens in the media. And sometimes what is said in the media is different from what actually is occurring for a lot of different reasons. So there is really no substitute for reading at a significant level of detail. What comes next? You can stay ahead of the curve, obviously, by using our data and our platform in a lot of different ways. And this is a shameless plug, I admit, but we will do it anyway. So for enterprise-wide deployments, we offer a range of APIs to institutions so that they can customize precisely which components of the policy process they want to follow on a daily basis on their internal dashboards. Those APIs are available and priced upon request and based on the deployment. If you want individual access or for small teams, you can customize which components you track and receive daily updates and have on-demand time series generation precisely for the terms that you care about. And then finally, the COVID-19 report every day. I provide an analysis of what I'm seeing. Now, that's not customized, of course, but it provides a sense of the high-level issues and under transition every day. So there are different entry points depending on your interest. You can find them all really at this email, thepolicyscope.io. With that, that takes us 45 minutes in. And if there are any questions, I will go look. It doesn't look like there are. You are more than welcome to unmute yourself and ask a question or post a question in the chat panel. With the screen sharing here, we can see the questions as they come in. If there aren't any questions now, and you want to absorb the ideas presented here, you're more than welcome to drop us a line in through, we have messaging options through both of our websites here or through my personal email. That concludes then our webinar for the day. I hope you found it interesting. It was a very quick run through a number of very significant issues, identifying where policy trajectories are taking us, and hopefully providing perspective on how quantifying the public policy process can provide predictive analytics and advance notice of significant inflection points as they occur. If you have any questions going forward, please do not hesitate to reach out. Thank you for your engagement and participation, and look forward to the opportunity to confer with you in the future. Thank you very much. Wait, there is a question. Hold on. Expectations for June. Thank you. Yes, I do have expectations for June. The expectations for June will be challenging. I'm going to go back to the slide at the beginning that we had of this on this webinar, because this one in particular, the run-up to the peak of pandemic policymaking this spring was all designed to generate a bridge to the summer. Policymakers did not know how bad the pandemic would be in round one. And I think more than one, it was clear we're hoping much would be over by summer. The economic policies put into place, fiscal policy, monetary policy, were all designed to get us through June. These support structures in many cases will expire in June. Where extensions can be made, they will be made. In fact, 2 days ago, Switzerland started the process by extending until year end the regulatory capital suspensions that they had already put into place, and they modified the relaxations of their anti-money laundering requirements. I expect we're going to see a spike of activity in June that will be a direct relationship, will have a direct relationship to the scale of economic recovery. Past June, I think we will see another spike of emergency policymaking in September and October for two reasons. Even if we do not have a second round of infections and mobility restrictions, the full toll of the economic crisis will become crucial to address as companies begin approaching the year-end process for closing out their books. And so when you look at this policy cycle here, the full year arc of policy is probably going to look a little bit more like a roller coaster. The best case scenario is that the roller coaster is like this, relatively smooth. The worst case scenario, obviously, is that in October, which is never a good month for the markets anyway, that October presents some additional volatility as policymakers scramble to contain really lasting damage. I apologize for being so dour, but that is how I think we will see it unfold. If there are no other questions, I will be happy to answer questions one-on-one as well following the webinar. Thank you very much for your attention and engagement. And this concludes the webinar. Thank you very much for your participation. Bye-bye.